Okay, good morning, everyone. Thank you for joining. My name is Rick Bensignor, and this is the weekly market outlook report on OptionsPlay. Lots going on to start off the day, as is typical these days. We've got, hold on one sec. We've got S&P futures down about 12. Rates, U.S. 10-year down about another 6 basis points or so to 1.78%. Crude oil is up over $4 at $100 a barrel, and nat gas up about 6 cents. And gold, despite the dollar being up decently today, gold is also up about $16 now, but off its high of looks like almost $30 higher. So let's get into things. As usual, the disclaimer, everything we talk about today is simply for educational purposes. The video is not intended to be used for individual tax, legal, investment planning advice. And of course, as I talk about, I'd be a buyer here, I'd be a seller here. It's all for educational purposes. These are not official recommendations that I am putting out. As we take a look at what's going on in the markets today, we'll take a look at the equity indexes, and they've certainly been all over the place with lots of volatility in the marketplace. We'll see what the bonds have done and the commodity market, especially oil and gold. We'll look at the sector rotation model and then get into a couple of names that look to be of interest for us. The main themes that we have for today. Certainly, Russia and Ukraine is still right at the top of the list. No change from last week. It is the most dominant piece of information that is going to push markets on a day in, day out basis right now. Even more important than the Fed, although the Fed's already kind of signaled what they're doing. So until the March meeting results come, we're not going to quite know exactly where they stand on how much they might be raising rates now, whether it's 25 bips, 50 bips, as so many people had thought, but given what's going on with Russia, that may change and potentially throw the market into a little bit of disarray. S&P, we'll look at the charts there on last week's decline. Even though intra-week we broke some key levels, by Friday's close, it held above everything it needed to. That's really important. So we look like we do have some type of trading bottom in place. GLD, the ETF that tracks gold, has been on a near-term breakout. It has cleared all downtrend lines that you can possibly draw from the all-time highs on its weekly chart. That's somewhat bullish, as well as the price action there. So we'll talk about that. And then credit spreads, they've actually narrowed over the last several days. We got out of our credit spread trade on Friday from in the know trader, so the timing was good there because it's really come in sharply over the last couple of days. So those are the four main things that we're going to talk about today. I do want to also, just in starting things off, mention to you that with the upped volatility that we're seeing, I tend to approach the markets somewhat differently from when you're not having 100-point S&P moves intraday. So the few things that come to mind are, A, you want to cut your size down. Unless you are an extremely proficient trader, you want to cut your size down. So if you normally trade, I don't know, let's say 10 spiders or 5 spiders, you might want to cut that in half just because of the volatility and how much movement there is. You can still make the same amount of money, but you can reduce the risk. And in this environment, it still comes back to, you want to play this game for a heck of a long time. You don't want any 1 or 2 or 3 bad trades in a row knock you out of the game. So cut your size down. That's certainly one thing you can do. And that also allows you to play slightly larger stops because you don't want to stop out with the volatility. It's frequent to see certain levels get broken on an intraday basis, but they don't last, but just enough to take out the stops. So trading smaller lets you put your stops a little farther away, you'd still have the same dollar exposure ultimately, but gives you a little more flexibility. Those are kind of the things that I often do in a volatile environment. And the other thing, which is completely apropos to this whole webinar altogether, is the fact that options are also a better way to play sometimes than the outrights, because at least with an option, if you're the purchaser, you know that you've maxed out what your loss can be at the beginning. And of course, volatility is high now, which means you're paying more than you normally would, and that's an increased cost in doing it. But you can offset some of that by doing a call spread or a put spread, and therefore you can take advantage on both sides of that trade for the increased volatility. So those are really the key things I do when markets get crazy like this. Let's start off taking a look at the VIX, and actually let me drag this out of my picture so that we have the full view of the screen. Notice how many times in the last year this zone that I've highlighted, this year-long resistance zone, continues to essentially top the bulk of the moves. You have a few spikes higher. They're intraday since November, so we haven't even closed above the top end of this zone, which is kind of in the 33, 33 and a half type area. So still, I'm kind of looking for this to potentially be important resistance. If we get above 32 and a half on a couple of closes, then you potentially open the door for a move all the way up to 44 3/4, which would be the propulsion target of breaking out above here. You know, the VIX still has a downward slant to it all the time. So even when we get spikes up, they're typically quite ephemeral, but if you're on the wrong side of that trade and you've sold volatility, it can be painful in the near term. But by and large, I like that this continues to hold as resistance. Perhaps some pullbacks as things calm down. You know, you want to perhaps, you know, think about buying more towards, let's say, trendline support. Also a better time to potentially put on option trades that you're laying out the money for. If you're a seller of options, then of course up here is a better place. But if you're looking to buy them somewhere down towards trendline support, is probably the better thing to do. Let's take a look at the AAII poll. Now, this is just one of the many polls out there, but one of the easiest ones for the public to get their hands on. On the left-hand side, we're showing the percent bulls. This gets updated on Wednesday, so we'll have some new stats for tomorrow. But notice where it is as of last week. It was just, as of last Wednesday, just one minor bounce off the lowest low of the whole move. Interestingly, bears were on the highest level of this entire kind of sell-off, and certainly since the beginning of this year, but even as we go back in time over the last couple of years. Therefore, this is kind of a pretty good indication from the public's point of view of just how bearish they were as of last Wednesday. And of course, we had the big plunk on Thursday, so they were right for a day and wrong since. So this may very well be another indication that the market is stabilizing, and that one can lean bullish. Even as we talk now, the S&P is only down 5 points, so things are improving a little bit. Let's get into looking at actual slides of what's going on. We're going to start with the S&P, and I purposely put up this chart just to show you that most people are going to draw a downtrend line in the S&P like this. Again, weekly chart. So I've taken, let me turn this into the pointer. Where is, let's see, laser pointer. So here, this red dot, most people are going to look at the all-time high and connect it to this high here. And here's your trend line. So we're still beneath trend line resistance. I'll tell you that I draw it differently. And I'll actually, in coming weeks, I'll do a seminar on why I draw trend lines the way I do. But I actually draw it from this high here to this high here in green. So we basically closed just a touch above it yesterday. Again, it's intra-week, too early to say we've broken above trend line, you know, the downtrend line from all-time highs. But certainly this is, we're far more on the cusp than the way the average person would draw this. So potentially a good little near-term breakout to the upside too. Here's the S&P daily chart. And what I've done here is highlighted the important levels that I think we need to pay attention to. So you'll notice Friday night, we closed here. And then, of course, yesterday we opened well lower. And in fact, futures opened much lower yesterday than did the S&P when the 9:30 New York Times session opened. Futures were basically down 100 last night, on Sunday night, sorry. But now that we're starting to potentially build a base, I'm looking at, I always like to look at the confluence of indicators. So in this circled zone here, that's in cyan blue, I've got the downtrend line from all-time highs. I've got a pullback up to the 200-day moving average. And I also have the bottom of the cloud all kind of near each other in the next several days. So that's potentially one target that I was looking to, if you're looking to sell into rallies, that's one place to, I would kind of call that first resistance. Second is the top of the daily cloud, which is at 45.21. Unrelatedly, at 45.26 is this dotted blue line. That's the TDST line. I've mentioned to you that that's the start or the highest high in the most recent setup countdown, the 9 countdown. That high is at 45.26. So you've got two resistance points that are essentially just five S&P points away. So that's another level. And then something called a trend factor, which is how much measurement off the lows there are. They are in 5.56% increments, something that DeMarket come up with. So we see that 45.72 to 45.91, that 19-point range is both the trend factor and where we peaked on the early February rally. So those are the three zones I kind of look at. Underneath, I think we're probably somewhere in the in S&P terms, it's probably just beneath 4250 to about 4200 is where the support is now. And that's a place that if the market gave me a chance to buy there, I would do that. Here's the weekly chart with, again, the key levels highlighted. Sometimes they match up to the daily, sometimes not. In this case, we've bounced at 41.64, the TDST line last week. 42.18 was the propulsion exhaustion level. We missed that on the January decline by just 4 or 5 points. We certainly met it there. And ultimately, we still bounced off of the bottom Bollinger Band last week by the close of the week, and we did it again this week. And you've got the top of the cloud here. So when you look and you put all this together and you see how many places the market actually has bounced off of, and at least for the time being, a lot of the Russia-Ukraine news out of the way doesn't mean things might not get worse. We don't know with a guy like Putin what comes next. We know he doesn't like to lose at anything, and therefore I don't see him giving up or walking away from this move that he's already started. But at least for the time being, we've got a place where, you know, we're continually seeing support. The one thing that we don't have with the S&P right now is a set of 9 count. So we still, for a couple of weeks, could still be dealing with this. However, if we close above the close on any Friday, if we close above the close from 4 Fridays prior, then you've killed this downward setup count and you help lock a low even more so. So these are the key levels to look at. 44.67 is both the conversion and the baselines for this week. From the cloud chart, 45.69 is the middle Bollinger Band, and that's pretty much where we topped the last time. And if we extend through there, look from 46.54 as resistance. Here's the QQQ. We had talked about last week that we had a minimum downside target of 330.09. We hit that last Thursday, opened beneath it last Friday, and then screamed to the upside. So that level did hold as support. That is approximately 11% beneath the recent high. That is a significant level in how we measure things. The 11% move now off of this low takes us just to about 354 or so. Plus, you have the downtrend line there. So that's your first level of resistance in the Qs. Look at this blue box here. You've got the 50-week moving average in red, the 200-week moving average in dark blue, the top of the cloud, and the next trend factor level up. So here's your really important resistance going forward. And it happens to coincide with where we bounced in early February. So that's the main resistance right now that I see in the Qs.
Hey there. Thank you so much for watching. I really hope that you enjoyed today's session. If you want to watch the full recording and all of the market mover symbols that I covered today, register for an account at OptionsPlay.com. You will access my daily trading signals to follow along and weekly options education sessions to improve your trading skills, and gain full access to our platform to analyze the risks, rewards, and probabilities for any trade. Regardless of where your ideas originated from, filter them out with OptionsPlay and start gaining confidence in your trades with our platform. And the best part is that you can start completely free with a 30-day trial. Click on the link in the description below to learn more. And as always, have a great trading day.